Many investors are searching for the best stocks to buy right now. They want clear answers, specific names, and immediate opportunities. Professional investors approach this question very differently. Rather than asking which stocks are the best, professionals focus on what characteristics matter most in the current market environment. This video explains how professionals evaluate U.S. stocks today and how they decide which ones deserve attention. This is not a recommendation and not financial advice. It is an educational overview of how professionals think about stock selection. The first factor professionals evaluate is business quality. Strong companies tend to have durable revenue, competitive advantages, and business models that can operate across different economic conditions. In today's market, professionals place a high value on consistency. Companies that generate reliable cash flow are often viewed more favorably than those that rely heavily on future growth assumptions. Cash flow matters because it provides flexibility. It allows companies to reinvest, reduce debt, return capital to shareholders, or withstand periods of economic stress without external financing. The second factor professionals consider is valuation. Even the highest quality company can be a poor investment if expectations are already priced too aggressively into the stock. Professionals assess how much growth, margin expansion, or efficiency improvement is already reflected in the current price. They avoid chasing popularity and instead focus on the relationship between price, earnings, and long-term fundamentals. Balance sheet strength is another critical consideration. Companies with manageable debt levels and strong liquidity are better positioned in uncertain environments, especially when interest rates and financing conditions change. Professionals distinguish between companies that can self-fund their operations and those that depend heavily on borrowing or capital markets. Earnings quality also matters. Professionals look beyond headline earnings and examine whether profits are driven by core operations or one-time events. Sustainable earnings are more valuable than short-term spikes. Sector positioning plays an important role as well. Different sectors respond differently to economic growth, inflation, interest rates, and market sentiment. Rather than betting on a single stock, professionals often think in terms of exposure. They ask which sectors align with current conditions and how individual companies fit within that broader context. Risk management is central to stock selection. No matter how attractive a stock appears, professionals control position size. A strong company can still create poor outcomes if it represents too much portfolio risk. Instead of focusing solely on upside, professionals consider downside scenarios. They ask how a stock might behave during market stress and how much damage it could do to the overall portfolio. Correlation is another important factor. Stocks that move in the same direction as existing holdings may add limited diversification benefit. Professionals prefer exposure that improves portfolio balance rather than concentrating risk. Time horizon also shapes decision-making. Professional investors evaluate stocks over multi-year periods. Short-term price movements rarely dictate action unless they alter the underlying business outlook. Importantly, professionals reject the idea of a universal best stock. What makes a stock attractive depends on its role within a specific portfolio. A company that is ideal for growth-focused investors may be unsuitable for those prioritizing income or capital preservation. Context matters more than headlines. The key takeaway is that identifying strong stocks is less about prediction and more about process. Business quality, valuation discipline, balance sheet strength, earnings durability, and risk control consistently matter. For individual investors, the lesson is not which stocks to buy today, but how to evaluate opportunities thoughtfully and consistently. This framework helps investors avoid emotional decision-making and remain disciplined across market cycles. This content is provided for educational purposes only and does not constitute financial advice.